Hello and welcome back to the channel. If you're new here, my name is Josh and I run an independent wealth management practice. Now, that makes me very interested in the ideas and principles around how people are building and preserving wealth in the modern age. What's the experience of that? What are some of the tactics around that? And that's what this channel is all about. And so something came across my emails very recently that was super interesting. It was a survey put out by Join Hampton, which is a new business created by Sam Parr. He's an awesome online creator around entrepreneurship. And his whole pitch is that it's kind of a dime a dozen on the internet to find people who can help you make money, but no one really helps you understand how to manage money once you've acquired it, which is a much more lonely and psychologically, socially difficult journey. And so today I want to talk about this new report, which is really cool. It surveys and summarizes how wealthy founders are managing their money. So this report has surveyed 127 people with a net worth between 1 million all the way up to multiple hundreds of millions of dollars. And today I want to see the insights and observations we can glean from this new data. And so firstly, the sample, 75% of them overwhelmingly are in the $1 million to $20 million net worth bracket. 9% are below that. And 16% of people surveyed had a net worth greater than $20 million. Now, where they made their money. This is interesting. 87% of these people owned a business, and only 6% of these people got wealthy from investment returns alone. And that's important to understand because unlike what you see on the internet, if we're looking at a sample size of 127 people here, only 7 of them created their wealth by owning crypto or Nvidia or some stock like Domino's or Apple over the last 10 to 15 to 20 years. It could also just be sample bias, but a vast majority of people who accumulate their wealth are first generation wealth builders. I believe somewhere around 80% of wealth, or people in the 1%, got there for the first time in their generation, which kind of goes against the prevailing notion that most wealth is just passed down. However, this stat, I believe, will probably change over the next few decades as this great wealth transfer from the boomers to the next generations begins. Now, let's talk a little bit about what they're aiming for. People in the study between 1 million and 20 million in net worth are aiming on average to double or triple their net worth, whereas people between 20 and 50 million aren't shooting to really build their net worth that much more. And this is interesting because in his book, How to Get Rich, which is oddly about how you shouldn't really want to get infinitely rich, the author Felix Dennis talks about how he wishes that he would have taken his foot off the gas earlier in his career, maybe at 30, and dedicated his time to writing, which was what he really loved. Now, not only that, but I have a couple friends of extreme means, and one time after a few drinks, I asked one of them, okay, so how much do you actually need to live the way you want to live right now? Because they live pretty much as good as a human could. And one of them responded, if you don't need all the plus, you can fly a nice jet but not have the biggest jet. You can have a nice boat, but you don't have to have the biggest boat that's bigger than everyone else's. Or maybe you're just okay with having amazing travel experiences as opposed to like these mind-blowing one-of-a-kind things. Want good cars and not maybe the one-of-one Bugatti, right? Like if you don't need all these plus items, you could probably have about as good of a human experience as possible on $100,000 per month. And if you wanted that $100,000 a month in perpetuity, that means you'd probably need around $30 million in total. And a friend of mine said, if you're not status obsessed about having the greatest things in the world and having better stuff than other people, it's really hard to spend much more than that as a reasonable person. So there's a lot of independent data I'm receiving from other sources that are saying $30 million is around a number where a rational actor who is not obsessed with status starts to realize that it's senseless to just pursue more money for money's sake. And this survey seems to be backing that up. Let's talk about what motivates them. That's interesting. So here we see that the main financial reasons behind their quest or their goal to grow further, they change as the level of wealth changes. But here's a few observations. At 50 million and above, the desire for more financial security, better lifestyle spend, and funding a better retirement go to zero. That's the point where more money isn't really helping you achieve anything financial. From there, it's all about personal development, making an impact, helping the next generation, these sorts of things. And another observation is that people are still worrying about retirement from that 1 to 19 million segment. But they kind of stop worrying about retirement at around 20 million in net worth. And this is helpful to people who are in that single-digit millionaire retirement scenario. There's probably no doubling or tripling of your net worth that will eliminate your concerns around retirement. There is no finish line where all of a sudden you just magically have enough. And if you want to get there, data is showing that's probably happens at around 20 million. At that point for you, it's probably more productive to work on eliminating retirement concerns through things like asset allocation decisions, prudent financial planning, as opposed to just working longer and accumulating a larger number, hoping that it makes the worry go away. Now, how is their wealth allocated? In a somewhat surprising conclusion, Founders between 1 million and 20 million have around a third of their wealth in their company's stock, which makes me curious where else it's stored given their aspirations. If this segment wanted to double or triple their net worth, as mentioned before, there seems to be a bit of discrepancy there in how much of their own company they actually own. Because if you want to double or triple your net worth at already such a large amount, that's not going to come from investment returns. That's going to come from their own operating company doubling or tripling. Now, this philosophy kind of follows nicely that the people between 20 million and 100 million have 2/3 of their net worth in their company's stock. These people likely have a balance sheet that's more conducive to growth. And lastly, the wealthiest cohort of over 100 million in net worth had nearly the smallest allocation to their own stock. I would assume this is because they got to the point they're at with their net worth because they were offered some silly multiple and already had their exit. The reason they have such a small allocation is because they've already built their net worth from exiting the company. The wealthier they were, the less of a percentage they had in public stocks and cash, and the more they had allocated to real estate. And this makes sense to me. You're more focused on preservation than growth. And in my experience, a lot of people of that level of wealth appreciate seeing something large and tangible, an asset they can see providing value and also acts as an inflation hedge. As for the portfolio composition, there weren't too many distinct patterns other than the fact that the wealthier they were, the less they had allocated to crypto and the more they had allocated to fixed income. Part of me keeps coming back to this idea that more isn't better at a certain point, and if you have 100 million, and in the traditional sense of how people see cryptocurrency, what would be the sense on gambling a bunch of money on crypto to have these disproportionate gains when I could have those assets in something safe that pays regular income, that is inflation protected? I can understand how for someone trying to preserve wealth, that just seems like a more rational decision. Now, this next part was blurred out as probably a lead magnet to join the club to get access, but it's pretty evident from the chart. It's all the other factors we've already seen. Dark blue is company stock, light blue is public securities, beige is primary residence, gray is investment real estate, green is cash. But none of this really tells us anything we don't already know. Now, this chart is interesting because in aggregate, wealthy founders are trend followers too. Between 2023 and now, they added allocations to the things that had gone up and they sold off allocations to things that had gone down. Public stocks and real estate have done well. Crypto, private equity, venture capital have done poorly, at least for the time period of the survey, until very recently, right? You might say, well, maybe the allocation went down because of valuation changes. Yeah, but their cash positions dropped a bit as well. So that infers that these founders were either spending more than they were earning to a pretty wide degree, or my hypothesis, they were actually making investment purchases with that cash. Okay, now this one is interesting. The professionals they use. Accountants and tax specialists are by far the most popular, with between 75 and 90% of these founders saying they use one. However, it leads me to wonder, what the hell are the other 10 to 25% doing? Filing their own taxes, doing their own tax strategy while running their company? That's just crazy. But for founders between 1 million and 50 million in net worth, 20 to 25% of them are using a CFP or RIA firm. And that seems shocking to me. And the deck even makes a little bit of a dig about advisor fees. However, the 20 to 40% of founders between 50 million and 100 million use some sort of managed solutions, whether it's a CFP, RIA, or their own family office. And that's where I kind of feel the need to step in here. I think a lot of this cohort, most of these tech-focused founders, they often have this belief, I'm generalizing, that advisors are useless and a harm to them and then some sort of leech. As an example, I'm a huge fan of Andrew Wilkinson, who is, by the way, all over their marketing and is one of the main guys in this Hampton group. I heavily encourage everyone to check them out. He's a beauty. But here's a passage from his new book. Now, as a planner, as someone who looks up to him, it kind of hurts, right? It's like, damn, it's really sad that someone of that caliber who I look up to views my career that way. But I'm trying to determine if maybe he's right. I think if you put every person who labels themselves as a financial advisor in a room, he's probably gonna end up being right on balance. And to be clear, I have never, ever asked a single one of my uber wealthy friends to become clients of mine. They're my friends. And if they wanted my services, they would ask. If someone is that closely connected, I wouldn't have to sell them in order for them to start with me. However, what I do find to be ridiculous about all this is the idea that there are people out there who are self-managing And if they're anything like the techie founder type of people I know, they're likely doing something like plowing millions and millions into a robo-advisor, an S&P 500 index fund, and then sprinkling some onto Nvidia, Amazon, that sort of thing. And so that brings me to a big observation about this whole survey. A huge part of this is that it's a very young group who tends to be idealistic about what they can maybe do themselves and where they can save a little money. And the pervasive marketing messages about low-cost investing and the tech echo chamber, how it's just terrible to pay someone else for their expertise because it might show your own lack of competence in your abilities, especially if you're going to delegate to someone who, God forbid, doesn't know how to code and start their own businesses. But in their defense, being young means they don't have that urgent pain in front of them of the retirement planning complexity. They're still earning money, they're still accumulating. Once they get closer to the decumulation phase, I suspect that as a group, a much larger percentage of them will probably start to use a planner. You see, I'm unapologetic. I'm of the belief that no one should rule out the idea of leveraging a good faith financial planner. We as a group have just done a terrible job of marketing the value of our services, but we see it every day with our clients. Let's move on to monthly burn rate. This chart's super interesting. People with 50 million to 100 million in net worth are only spending $30,000 a month. And that's really interesting and goes to show you that the Instagram effect is real. If you were to live like the Instagram kids do, these become your own millionaire, Lamborghini, mansion, yachts, your monthly spend would easily be over $100,000. But here we have legitimate founders who have a lot of real world money, and a lot of them are spending $30,000 a month. In reality, it's mostly people snapping pictures and videos when they're doing the craziest stuff they ever do. It kind of goes to show that people of insane means who could spend as much as they want rarely spend more than $60,000 a month, even if they prudently could. Now, this estate planning side is also quite interesting. The more kids you have and the older you get, the more estate planning work these people have done. Who would have thought, right? However, it is interesting that a huge number of these people have an estate plan underway or already completed, and a much smaller portion of them work with a CFP or RIA, which likely means the accountants, the lawyers, and the tax specialists are playing a much larger role in the estate planning than their advisors are. And so hopefully this has been interesting for you to walk through this Hampton survey of these wealthy founders and maybe give you insights into how wealthy people are managing money. And for us advisors, what kind of challenges we have in communicating what it is that we do that can help people preserve wealth, grow their wealth over time, and all these sorts of things. So anyways, thank you so much for watching this video, and we will see you in the next one.